RYLD stands for the Global X Russell 2000 Covered Call ETF. It is designed to generate high income by selling covered calls on the Russell 2000 index. That is important to understand upfront. The Russell 2000 tracks small cap stocks, meaning smaller publicly traded companies. So unlike QYLD, which focuses on large cap tech through the NASDAQ 100, or XYLD, which covers the SP 500, RYLD targets the more volatile and riskier forms of the market, and small companies that can grow fast but also drop fast. And RYLD makes money by writing or selling call options on those small cap stocks to generate consistent premiums, which are then distributed to shareholders as dividends. Let's begin with the payout tracker. RYLD pays a monthly dividend, and it is known for having one of the highest yields in the market. As of July 2025, the average dividend is between 22 cents and 26 cents per share each month. That comes out to around $2.70 to over $3 annually. If you buy the ETF when it is priced around $20, that equates to a yield between 13% and 16%. This yield is not fixed and will fluctuate, but it's one of the few ETFs that has consistently paid double-digit yields for years. Now let's move to the income table. If you own 100 shares of RYLD, you will receive around $24 per month, or approximately $288 per year. 500 shares would generate about $120 monthly, or roughly $1,440 annually. 1,000 shares will get you $240 per month, or over $2,800 per year. This kind of monthly income can be incredibly attractive for retirees, income investors, or those looking to cover recurring bills with passive cash flow. Now let's look at the net asset value and price performance. RYLD usually trades between $19 and $22 per share. But here's the key. The share price tends to stay flat or drift downward over time. Why? Because the ETF is not designed for growth. It gives up upside potential by selling covered calls. That's how it earns high income. But when small cap stocks go up, RYLD misses out on most of that gain. And when small caps fall, which happens often, the price of RYLD can drop even further. Over the last few years, RYLD has slowly declined from the $22 to $23 range to closer to $19 or $20. This is not a growth ETF, it is an income product. Let's compare RYLD to other covered call ETFs. QYLD, which writes calls on the NASDAQ 100, has a similar yield but slightly better performance due to tech outperformance. XYLD, which uses the SP 500, is more stable and has lower volatility. RYLD is the most volatile of the three because it is based on small cap stocks. That means it also has more downside risk during bear markets or recession. But on the flip side, the option premiums are larger, which is why the dividend yield on RYLD is often the highest. Now let's talk about fees. RYLD has an expense ratio of 0.6%, or $60 per year for every $10,000 invested. That is a little higher than traditional ETFs like SPY or VOO, which are closer to 0.05%. But the extra cost is due to the active options management. The fund is constantly writing and rolling one-month call options to generate income. Let's talk volatility. RYLD tracks the Russell 2000, which includes 2,000 small companies. These stocks are more volatile than large caps, especially during economic downturns. That means RYLD will move up and down more than QYLD or XYLD. But because the ETF sells covered calls, some of that volatility is offset by the option premiums. Still, you should be ready for price swings. This is not a set-it-and-forget-it holding if you are focused on preserving principal. Now let's talk risk and sustainability. RYLD's dividend is not backed by company profits or interest income. It is funded entirely by the premiums received from selling options. If the options market dries up or if volatility collapses, the income can shrink. And because the ETF sacrifices capital growth for income, long-term holders may see slow erosion in the share price. That is the trade-off you are getting paid now, but your shares may slowly lose value over the years. That is why some investors combine RYLD with growth ETFs to balance the equation. Next is the exit strategy. RYLD is best used as an income supplement. It is not ideal for total return investors who want to see their portfolio grow over 10 or 20 years. It is also not great for tax-deferred accounts if you do not need the income yet. But if your goal is to receive monthly cash flow, and you understand that the price may decline over time, RYLD is a powerful tool. Many investors treat it like a bond alternative. Instead of holding treasuries yielding 4%, they hold RYLD to earn up to 15%. Now for my meter rating. Income, 10 out of 10. RYLD offers one of the highest and most consistent monthly payouts in the ETF world. Risk, 8 out of 10. Small cap exposure and declining NAV make it risky for long-term principal preservation. Sustainability, 6 out of 10. Covered calls work best in sideways or volatile markets, but long bear markets or low volatility could hurt payouts. Upside potential, 4 out of 10. The fund gives up growth in exchange for income, so the long-term capital appreciation is limited. Ease of ownership, 7 out of 10. It is simple to hold, but requires monitoring if you care about your account balance, not just your income. Final total rating, 7.5 out of 10. RYLD is not a get-rich ETF, it is a get-paid ETF. For the right investor, someone looking for high monthly income and not worried about slow capital erosion, it can be incredibly useful, but it's not for everyone. Understand what you're trading. You are giving up the potential for growth in exchange for income today. If you have any videos you'd like me to cover, say it in the comments below and I will break it down in plain English.